Good morning, it's Jeff Christian, CPM Group, about 10 minutes after 11 o'clock on Tuesday, the 14th of September. Wanted to talk a little bit about our market outlook. Last Friday's video did not say where we thought the market was going. And a couple people said, gee, I'd like to know where you think the market's going, where we think the market's going, because we've actually been a little bit off pace the last several weeks. Over the course of August. So I'll talk a little bit about that. And then some of the comments that have popped up in past videos, I'm going to answer or address a couple comments, a couple questions, and a few other things. Try to make it relatively short. So here's gold prices and silver prices since the beginning of 2019. The prices did come down in early August. They were stronger for the rest of August than we had expected. That led us to think that perhaps we had seen the short-term lows and that we could see prices strengthen further over the last 4 months of the year. There's seasonality factors there. There's some economic factors. There's fabrication demand tends to pick up. Investment demand also tends to pick up. And frankly, the world is in a kind of place where people should be thinking about gold and silver. No sooner had we said that than the prices backed off. But what we've seen is that the prices are trading in relatively narrow ranges. 1780 is a support for gold, about 1800 right now. It was 1815, 1820 a couple weeks ago. And gold seems to be sort of range bound in that. It came down and tested 1780 yesterday and this morning. CPI came out and actually was very positive economically, but the gold price did come back and it was testing around 1800. Silver, again, it's trading between 2300 and 2450, and it's sort of range bound. There is the potential for spikes lower, not much more. When we saw the gold price spike down in early August, it went down sharply to around 1680 or so. We think that there is good support at 1780. If that holds, if that breaks, maybe 1760. We don't see it going back down to 1720 or anything like that, I don't think. Here. And then beyond September, we do think that the price will strengthen, even though in the last 2 years, the fourth quarter has seen weaker gold and silver prices. For silver, a break below 23 could take it down as low as 22. We think it would be relatively short-lived. The silver market's probably not as strong as the gold market right now in terms of investment demand patterns. There are some stable liquidations going on in both, and there's an increased proclivity of people to be willing to short the markets on a short-term basis, both gold and silver. Beyond September, we think that the silver price also will probably move somewhat higher. It's kind of funny because I am going to be talking about comments. And last week, somebody said, yeah, you stomp on gold and silver. Yeah, we're predicting record gold and silver prices in the next 4 or 5 years, which hardly sounds like we're stomping on the markets. And we are telling investors that from a longer-term perspective, they should be buyers. From a short-term perspective, they probably also should be buying, which sounds like we're not stomping on the market. But, I've learned that some people don't actually listen to what people are saying, much less read what they're saying. We also had a comment last week. I had a comment that in the tech bust in 2000, 2001, we lost not we, I gotta stop saying we because people say, oh, Jeff Christian lost $5 trillion. No, the stock market and investors in the stock market lost $5 trillion in the tech bust. And I said, adjusted for inflation, that would be today around $8 trillion, which is roughly equivalent to the amount they lost in the mortgage bust in 2007, 2008, and not quite as much as the $9 trillion in economic activity that the United States lost in 2020 with the economic lockdown. Of course, someone criticized me and said, how stupid can you be to think that $2 trillion in 2000 is $8 trillion today? Well, I guess I would be pretty stupid, but I didn't say that. I said $5 trillion, adjusted for inflation, $8 trillion. And I put it in writing. So if he couldn't hear, he could read it, but he didn't. It's just fine. Which takes me to my next point, which is some of the comments and questions that we've had. I watched the conservative commentator and former Republican George Will on television Sunday. And they asked him a question. I'm not sure if it was about people stupid enough not to get vaccinated or people stupid enough to think that the election was stolen or what. And they asked him a question about it, and he simply said, the United States is suffering from a pandemic of mindless truculence. Which is a wonderful phrase, mindless truculence. I actually had someone say to me, they started talking to me about how I was part of some grand conspiracy of banks and bullion dealers to suppress the prices. And almost within the same sentence, definitely within the same paragraph, they then started ranting and raving about how the pandemic didn't really exist, the vaccinations were going to alter our DNA, and the election was stolen, and the insurrection was run by Antifa. I said, wow, that's mindless truculence. That's like just taking every grievance you have, except maybe some warts on your back, and saying they're all related. And that's where we are as a country. And it's not surprising, and it's not a black swan event, because in 1996, Newt Gingrich took over as Speaker of the House, and he said, there is no value in the Republican Party cooperating with the Democrats. And ever since then, we've had this division in the government and then subdivisions. So Republicans fight Republicans, Democrats fight Democrats. It's not all the Republicans' faults. The Democrats have done a piss poor job of responding to the Republican war that Newt Gingrich started. But the reality is that we have a broken democracy. And there are a lot of people who are making a lot of money feeding on that broken democracy. It goes back to something in 1933 that the great philosopher Groucho Marx said. Actually, he sang it as Rufus T. Firefly in Duck Soup. He had a great song called Whatever It Is, I'm Against It. Mindless truculence. Now, on to some better ideas. Several months ago, actually back in March, after one of our videos, someone asked me, speaking favorably of the Hunt brothers, but talking down the silver squeezers, yet they are doing exactly the same thing. What's that all about? That's weird. Well, first off, it's not at all weird. Second thing is, they're not doing the same thing. The Hunts were investing in silver in the expectation of prices rising. And because they were wealthy, they bought a lot of silver. And because they had bought a lot of silver, they felt free to talk to other people about how smart they were in buying silver, with the expectation that some people would say, gee, those guys are smart, I'm going to buy silver too, and that might help the price rise. They also said to the banks and brokers who had been buying silver for them, hey, if you want to mention to your other clients what we're doing, feel free to. So they saw a wave coming that was going to push silver prices higher. And they said, let's ride that wave. And if we can make some comments and let other people make some comments about what we're doing, and that increases the height of the wave, so much the better. They did not try to squeeze the market. They were trying to ride that wave and maybe make it a little bit taller. And they didn't collude. They didn't go on the internet, which actually didn't exist. It did exist back then as part of a Defense Department program. They didn't go out and say, hey, everybody should buy silver and squeeze this market and drive the price to $100 or $200 or $1,500. They said, we think the silver price is going to rise and we're buying silver. And if you bought silver, you could be a cowboy too. And that's what they did. Completely different from a bunch of people going on the internet and saying, hey, let's collude to squeeze the silver market based on an erroneous view of what's going on with the short positions on COMEX and misinformation that we're consciously putting forward that the world is running out of silver. That's collusion. The Hunts didn't collude. The Hunts were investors. They weren't marketeers trying to suck money out of investors. Now, the second question, how do I buy a 1,000-ounce silver bar or a kilo gold bar off the COMEX and have it delivered in my house? I can tell you that. Well, I will tell you that, but I'll also tell you that's not what you should do if you're an investor. And it's not what you should do if you're trying to squeeze the market either. It's what you do if you don't understand the markets, but we'll get to that in the fourth point here. You can buy a contract, 5,000 ounces in silver, 100 ounces in gold, and when you have the delivery month of that futures contract, you can stand for delivery, and you can have your broker take delivery, take the metal out and sell it to you. Some brokers will say, I'm a futures broker, I don't get involved in physicals. Others will do that. But it doesn't make sense for you, either as an investor or someone who's trying to collude to squeeze the market, to do that, because it's an extremely inefficient way to do it. If you're an efficient investor, you would buy a 1,000-ounce silver bar or 3 kilos or whatever you want from a legitimate, honest, substantial bullion dealer, a reputable dealer. Yesterday, the premium at one of the dealers that we trust and respect and use a lot for our client business was charging 2.4% over spot for 1,000-ounce silver bars. So if you're an investor, a legitimate investor, you'd buy a bar from a reputable dealer. If you wanted to draw down metal from the COMEX, you would buy that same bar from that same dealer in that same way, in the most efficient and cost-effective manner for you, because that dealer keeps his or her or its silver and gold in COMEX depositories. So you're having the same effect of taking a 1,000-ounce bar out of that depository, and they will deliver it to you in an insured overnight or 3-day delivery package. Either some people use USPS, others use UPS, DHL, FedEx. It's one of those couriers. And you can have that done for you in a cost-effective way, and it has the same effect on the market. So in other words, what I'm saying is, it does not make sense for someone to say, I want to take a 1,000-ounce bar or 5,000 ounces off of the COMEX, and so I'm going to take delivery of a bar. I know some investors who do it, including my favorite, alcoholic billionaire that I've mentioned in the past, but it just doesn't make sense to do that economically. And I like sensible economics. Another comment, I wish someone could take me through hedging and help me understand it. That's a bigger issue. Let me try to briefly say it. If I'm a producer, I'm spending a lot of money to make metal. From a refiner or a smelter, I'm spending a lot of money to make metal. If I'm an intermediary, I'm holding inventories, and I'm probably telling a producer, a smelter, or a refiner, hey, I will buy that metal for you at today's price, let's say $1,800. And I'm going to hold that metal in my inventory until somebody wants to buy it. Really good, one of the reasons why a lot of the trading is done by large companies is because there's a cost advantage to being large and to being spread across the market, so that when somebody says, I want to sell you gold at $1,800, you can almost immediately find somebody says, I want to buy gold from you at $1,802, so that you don't have that metal sitting on your inventories. But you are, in fact, as a market maker, taking a price risk if you're buying that metal and you don't have an immediate seller. So the producers say, I'm spending all this money for metal that I hope to be able to sell at $1,800 or more, but the price is volatile. It could be $1,200 again by the time I'm ready to sell this metal. 1 year, 1 month for current production, 1 year, 2 years, 20 years. So I'm going to hedge my exposure. I can sell this gold at $1,800 in a forward market contract or an options contract and lock in that price. My cost of production, on average right now, it's less than $1,000. I'm building in a very nice margin, like an 80% margin. I'm assuring myself that my company can continue. If I'm sophisticated, I might, instead of selling that in the forward or the futures market, I might buy a put that allows me to sell it at $1,800. Now, I'm giving up upside, whichever of those three things. Well, I'm giving up upside if I sell it in the futures or forward market. If I buy a put that gives me the right to sell it at $1,800 in the future, I'm giving up the cost of that put, which could be $10, $20, depending on the volatility in the gold market at the time and how long you're going for, how long forward you're hedging. CPM Group likes to have its clients say, I'm going to buy that put, and then I'm going to sell a call, maybe at the same strike price, maybe at a slightly higher strike price. That's going to generate a net premium that I'm going to buy another call above that. So let's say the price is $1,800. I'll buy a put at $1,790. I'll pay for it with a call at $1,790. That call is $10 more profitable, whereas the put I bought is a $10 loss, mark to market at $1,800. So the call generates a bigger premium than the premium I just spent on the put. I say, okay, I have another $10, let's say. Let me buy a call above this. Okay, I can buy a call at $1,820. So now I'm giving up $30. I'm guaranteed the price of $1,790. And if the price goes over $1,830, I get the market less $30. So I'm keeping most of the upside exposure for myself. That's how we like our clients to hedge if they're producers, smelters, refiners. The World Bank looked at our hedge and said this probably is the most effective, cost-effective way of hedging commodity price risk management. But that was 22 years ago. If I'm a consumer, it's the exact opposite. I want to lock in a maximum price that I'm going to pay. So I might buy a call and pay for it with a put spread. But the act of hedging is protecting myself from price moves so I can pay attention to my business. I'm a miner, I'm a jeweler, I'm an electronics component manufacturer. I need to focus on mining or making jewelry or making electronic components. And I really can't afford to lose a lot of money because of price swings in a volatile market, right? So that's why producers and consumers hedge. And they don't use futures and options themselves directly. They tend to go through dealers because they don't have the sophistication to do this kind of thing. And then in the middle, you have a wide range of market makers, bullion banks, dealers, and traders who serve as market makers. They're buying from sellers and they're selling to buyers. And they have price exposure and they have working inventories and they hedge that. And they finance themselves basically with borrowed money. And the companies that are lending them that money, even if it's the same bank, different part of the bank, says, I will lend you money to trade commodities, but given the volatility of commodities, you have to be fully hedged. So every time you're buying a forward contract from a producer, smelter, or refiner, you got to be selling someplace. If you can't find an offset in the physical market, you need to find an offset in the forward market, or you turn to futures or options, or sometimes these days you use ETFs, right? So if I'm selling, if I'm a market maker and I'm selling to fabricators, or I'm leasing to them, so I bought the metal, I have a price exposure, I have agreed to pay a certain price, I'm leasing it to somebody who's going to buy it at some point in the future when he sells the product that he's used that metal to make. I have this massive price exposure that I have to deal with. And I'm going to use futures or options or ETFs or forwards or dealer options. That's really what hedging is. And it's very important to understand because futures markets were first created in Japan and in Europe, like in the 15th, 16th century. And they were created by merchants who were taking these massive exposures in commodities that they were shipping back and forth between Europe and Asia. And they said, I'm putting up a lot of money to go off in Asia and buy these various commodities. And by the time that ship comes back, if the ship comes back, if the ship makes it back, I've got this enormous exposure. So they found futures markets to allow them to hedge their exposure to the commodities. Now, say, okay, so I want to sell these things forward to lock in my prices. Who am I going to find to buy forward? Investors. Investors who say, well, I don't know anything about gold or silver or copper or spices, but I got excess money, and you tell me it's a good investment. So yeah, I'll agree to buy that stuff from you when your ship comes in. Hopefully, the ship comes in. And that's where futures markets come from. They started by providing a facility for merchants to hedge their price exposure. And they found that they could do that by finding investors willing to buy price exposure, not physical metal, not physical commodities, but exposure to the prices. And that's one of the things that a lot of people just don't get when they're talking about the futures markets. Most people who invest in futures don't want gold or silver or copper or soybeans. They want profits through exposure to changes, hopefully rising prices, but they can also sometimes short the market. They want price exposure, not commodity, physical commodities. And a lot of people just don't understand that, which leads to my next comment here. Do you hold lessons on how futures markets work? Because many people do not understand them, which I think engenders conspiracy theories. And it does. It doesn't engender the conspiracy theories. Those are the conflict entrepreneurs, the snake oil salesmen and carnival barkers that we've talked about, who go out there and try to generate business for themselves or their sponsors by fear and ignorance. Charles Dickens? No, that was wanton ignorance. I'm sorry. So we don't actually, well, we do train people on futures markets. Right now, what we've been doing it is on an individual corporate basis. So a corporation will say, my people really need to understand futures markets. CPM Group, either put together a one-day thing or a 5-day thing or ongoing event consultancy where you can explain futures markets and how the commodities market, not just the futures markets, but also the physical markets and options markets. Explain all of this to our executives, our financial people, maybe our board, and be available to answer questions. And that's one of the services that we provide. So when I hear something like, oh, I just heard that there's a whole lot of gold that showed up in Uganda, what do you know about it, Jeff? Well, I know that it's gold that the Hugo Chavez people spirited out of Venezuela, took out of the central bank, basically stole from the central bank, let's be honest, and spirited it off to Uganda to have it melted down and recast as Ugandan refined bars in the hopes that no one realizes that what they've done is pillaged the central bank gold reserves for their own well-being. And then they shipped it off to Europe and it was picked up. People said, gee, that's weird because Uganda doesn't make that much gold. So that's one of the things that we do. You can learn more about us at our website. There's an introduction to CPM Group that you can find on YouTube. You can buy our yearbooks, which talk about a lot of things that I just was trying to explain. You can be a retail investment program client, get some of our shorter term views, our gold trade recommendations, our silver trade recommendations, ask us questions, plug into our open forums. And again, as I mentioned last week, I will be at the Silver Symposium in Idaho, 26th through the 28th of September. On Monday, I'm giving a 40-minute talk on what really goes on in the silver market. History of the silver prices, not going way back, but I'll have some data that goes back to, say, 1800. But most of what I'll talk about is really, post-World War II, because it's really what matters. Past, present, and future, the outlook. Then on Tuesday, I have this brown bag lunch, open discussion, Q&A, ask me about stuff. How did you know about Hugo Chavez's gold going to Venezuela? And then we have a workshop called Investing in Gold and Silver in a World That's Not Collapsing, which talks about how to be a rational investor and say, I want to, A, preserve my wealth by having some of my assets in gold and silver. And I also want the opportunity to make money on some of my assets too. Because as Adam Smith said in The Wealth of Nations, which he published in 1776, you don't measure your wealth by the amount of gold and silver and currencies that you have in your safe. You measure it by your investment in productive units of output that can make more gold and silver. So it's good to have gold and silver and currencies in your safe. But what you really need to do, because all of those are depreciating assets by definition, the nature of currencies, gold and silver, as financial assets causes them to lose value over time. You really want to take some of your wealth and invest in gold mines or silver mines that will make more gold and silver, preferably for you. That's all I have for now. Talk to you on Friday. In the meantime, be good, stay clean, stay safe, and we'll talk then.